Hey everyone, welcome back to Corporate Decoder. Today VKTX just filed its quarterly report for the period ending June 2026, and I am seeing some major shifts in their cash and financial strategy that really matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is spending a lot more on research and development for their new drugs, and while their cash pile is shrinking, their new stock sale strategies and a massive new share buyback program might signal a big pivot. So Viking Therapeutics, or VKTX as you might know them, has just released their financial results for the second quarter of 2026. Even though they are a clinical stage biopharmaceutical company, meaning they are still developing their products and not yet selling them, these reports give us a crucial look at their financial health and future plans. Let's jump right into the numbers. Looking at their balance sheet at the end of June 2026, we see some pretty significant changes from the end of 2025. Their total assets have dropped quite a bit from over $715 million down to about $521 million. This is mainly because their short-term investments, which are their safe place to keep extra cash, have gone down substantially. They had over $539 million in short-term investments at the end of last year, and now it is down to just over $375 million. Their cash on hand has also decreased. As of the 30th of June 2026, they had around $125 million in cash and cash equivalents, compared to over $165 million at the end of 2025. This drop in cash and investments is a big clue about where they are directing their money, and we will get to that. On the other side of the balance sheet, their liabilities have gone up. Their accounts payable, which is money they owe to suppliers, has increased from about $53 million to almost $69 million. They also have more in other accrued liabilities, going from around $23 million to over $40 million. This suggests they are increasing their spending and possibly taking on more obligations. Now let's look at stockholders' equity. Their additional paid-in capital has increased, which usually means they have issued more stock. For example, in the first 6 months of 2026, they added over $57 million to this account through stock issuance and sales. This tells us they have been raising capital by selling more shares. Moving over to the income statement, there is no surprise here as the company still has no revenue. As expected for a clinical stage biotech company, their primary activity is spending money on research and development. For the first 6 months of 2026, their research and development expenses reached nearly $266 million. That's a huge jump from about $101 million in the same period of 2025. This massive increase shows they are doubling down on their drug development efforts, especially for their VK2735 program. For their Q2 alone, R&D spending was over $115 million. Compared to about $60 million in the prior year's second quarter. Their general and administrative expenses have also increased, but not nearly as dramatically as R&D. For the first 6 months of 2026, these costs were about $30 million, up from roughly $28 million in the first half of 2025. All of this spending means they are continuing to operate at a loss. Their net loss for the first 6 months of 2026 was almost $286 million. That is a significant increase from a loss of about $111 million in the same period of 2025. This bigger loss is a direct result of that surge in research and development spending. Now let's look at how they are managing their cash. During the first 6 months of 2026, Viking Therapeutics used nearly $239 million in cash from operations. This is a big jump from the roughly $99 million they used in the first 6 months of 2025. Again, this is driven by that increased spending on R&D. On the investing side, they actually generated cash. For the first 6 months of 2026, they had over $163 million provided by investing activities. This came from selling and maturing investments as they likely needed to tap into that cash pile to fund their R&D activities. They brought in about $461 million from investments maturing in 2025 compared to $267 million in 2026, but they also bought fewer investments in 2026, which freed up more cash. This is where things get really interesting. You see that cash provided by financing activities in the first 6 months of 2026 was over $35 million. This primarily comes from their stock sales. They brought in about $34 million from their at-the-market or ATM equity offering. This is a way for them to sell shares directly to the public over time when the stock price is good, which they've been doing. But here is the really significant part of their financing strategy. They voluntarily terminated their old the market equity sales agreement in late July 2026. And on that same day, they put in place a new at-the-market equity offering agreement. This means they are ready to sell more shares if the market conditions are favorable. This is a common strategy for biotech companies needing cash to fund their expensive clinical trials. But that is not all. In July 2026, they also terminated their previous stock repurchase program that was authorized in February 2025 to buy back up to $250 million worth of shares. And immediately, they authorized a new stock repurchase program. This new program allows them to buy back up to a massive $500 million of their own stock over the next 3 years. This is a really strong signal. Usually, companies buy back stock when they think their shares are undervalued or when they have a lot of excess cash and want to return it to shareholders. Given that VKTX is still burning through cash rapidly for R&D, this $500 million buyback authorization is a bold move. It suggests very strong confidence from management in the company's future prospects and that they believe the stock is currently undervalued. It also might be a strategy to offset potential dilution from future stock issuances or stock options. Now, let's talk about the risks. This company is very upfront about the challenges they face. They clearly state they are a clinical stage company, meaning they haven't brought any products to market yet. They've accumulated a significant deficit of over $1.1 billion. They expect these losses to continue and likely increase as they move forward with these expensive clinical trials. Scroll are substantially dependent on technologies we license from Ligand Pharmaceuticals Incorporated, or Ligand. And if we lose the license to such technologies, or our master license agreement with Ligand, or the master license agreement is terminated for any reason, our ability to develop existing and new drug candidates would be harm Eddie Scroll. A major risk they highlight is their dependence on Ligand Pharmaceuticals Incorporated. They hold exclusive rights to key compounds from Ligand, and a disruption here could severely harm their development pipeline. In fact, Ligand has initiated a legal dispute to terminate their license for the Tata Beta program, which includes their VK2809 and VK0214 drug candidates. This is a big legal battle they are currently fighting. They also face intense competition, especially in the obesity drug market where their VK2735 is developing. They list major players like Novo Nordisk and Eli Lilly and a whole host of other companies with similar drugs in development. If competitors get their treatments approved faster or find them to be more effective or safer, VKTX could lose out. Looking at leadership changes, it is notable that their Chief Operating Officer, Marianne Mancini, is retiring effective the 31st of July 2026. She will transition to a consulting role though, providing services until early 2030, which is a good sign that they are aiming for a smooth handover and retaining her expertise. Also, an interesting addition to the board is Dorothy Kelly Gemmell, who has extensive experience in commercial leadership in healthcare and digital health. Her background, especially in commercialization and growth, could be very valuable as the company advances its programs. So, what's my take on all of this? Viking Therapeutics is making bold moves. The massive increase in R&D spending and the simultaneous initiation of a new larger share buyback program, right after terminating their previous one, suggests management has serious conviction. They are betting big on their drug pipeline, especially VK2735. And they are signaling that they believe the stock is underappreciated. The legal dispute with Ligand over the Tra-Beta program is a significant risk, and the outcome will be crucial for those specific drug candidates. However, the company's primary focus seems to be on its metabolic and endocrine disorders programs, especially VK2735, which is progressing well into phase 3 trials. The company is burning through significant cash, as expected for its stage, but their ability to raise capital through ATM offerings, and now the large buyback authorization suggests they are confident in their path forward. The risk I am watching most closely is the Ligand dispute, but the sheer scale of their R&D investment and the confidence shown by the buyback program are very bullish signals for their core metabolic programs. What I am actually looking for is confirmation that their phase 3 trials continue to show positive results, which would justify this aggressive spending and strategy. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like and subscribe, and join our Discord community in the description.